Okay, Chapter 2, Financial Statements and Cash Flow. So this is where we begin to get into the accounting that I mentioned previously. So key concepts and skills that understand the information provided by financial statements, differentiate between book and market values, know the difference between average and marginal tax rates, know the difference between accounting and fund and cash flow. They're very different. Accounting is done on an accrual basis. So when an accounting, when a transaction is entered into, it is recognized at that point. So the transaction takes place. The cash flow may not change. Cash may not change hands for some time, but when we in accounting we recognize those activities when they're entered into, as opposed to when the transaction actually occurs, for which what we do with regard to cash flows. And then we're going to calculate a firm's cash flow. So, chapter outline. The first thing we're going to talk about is the balance sheet, income statement. So, if we're going through a set of financial statement. The first financial statement we'll see will always be the balance sheet. Then next will be the income statement. They will always created in the same order. So I'm going to get comfortable looking at financial statements and working our way through financial statements. And taxes. Then we're going to talk about net working capital, cash flow to the firm, accounting statement cash flows, cash flow management. So lots of sources of information out in the marketplace. Annual reports. You can literally, if you send a letter to a firm, you can go online, get their address, and send them a letter, and they will send you their annual financial reports. A lot of times, if you're a shareholder, you will actually receive those. The Wall Street Journal is also a source of information. The internet, the NYSE's website, NASDAQ's website, the textbook website, MHAE.com, the SEC website, Edgar, and then 10K and 10Q. Those are reports that the corporations prepare on a quarterly basis. Excuse me. So the balance sheet. The balance sheet is an accountant's snapshot of the firm's accounting value. It's at a specific point in time. So it's a picture is one date and time. Generally, year end can be it can be December 31st. Many corporations end their year on September 30th to June 30th, so forth. But the balance sheet would be as of that date. The balance sheet identity is assets equal liabilities plus shareholder equity. So assets being the left-hand side of the balance sheet, and liabilities and shareholder equity being the right-hand side of the balance sheet. We'll see on the next slide how those are laid out. So this is that we have assets over here, so total assets. So that's equal to total liabilities and stockholder equity. So that is our accounting equation. These the two sides have to balance. That's why it's called a balance sheet. They have to be equal. So, also, should we need to note that assets are listed in order of their liquidity. the time that it would take them to convert into cash. So if we're looking at the asset side, the current assets are much more liquid than fixed assets. So we list current first, then on the right-hand side, our current liabilities are those that are due in the near future. A lot of time you will see current portion of interest payable here at under current liabilities. Then we have long-term liabilities, and then stockholders' equity. So that is the balance sheet. Obviously, as the bullet point says, cash is much more liquid than property, plant, and equipment. And we can cash is cash. We can use it immediately. If we had some sort of securities, they would likely be more liquid than property, plant, and equipment. It'd be easier to sell them in the open market for the most part, unless there were some sort of risky security that was thinly traded. So, balance sheet analysis. When we're analyzing a balance sheet, we need to be aware of liquidity, debt versus equity, and value versus cost. So the accounting is done on a cost basis. We're not the balance sheet is not necessarily reflecting or doesn't reflect increases in asset values. The liquidity, talked about it a little bit already. The liquidity refers to the ease and quickness with which assets can be converted to cash. So, without a significant loss in value. So, you think about, cash is obviously the most liquid. The next most liquid would be U.S. Treasury bills. The spreads on U.S. Treasury bills they can be like pennies on a very sizable transaction. They're very, very liquid. You can trade with a dealer. You can also trade directly with the U.S. government if you choose to. Current assets are the most liquid. Some fixed assets are intangible. Factory, so forth. But also one of the things that we look at is inventory. The example I like to use is, Apple. If Apple has a warehouse full of iPhone 6s, those are probably fairly illiquid assets because there probably aren't a whole lot of people lining up to buy iPhone 6s. But on the other hand, if they have iPhone 11s or whatever the latest version is, those are going to be much more liquid. They're going to have a much easier time selling those. So the more liquid a firm's assets, the less likely the firm is to experience problems in meeting short-term obligations. Primarily, we're talking about the risk of default in the short term. So liquid assets frequently, and especially right now, have lower rates of return than fixed assets. So if you have a money market account, the return on your money market account is probably, pretty close to zero. All right. So next lecture, we'll start with debt versus equity.